Hey guys, happy Saturday, February 22nd. I want to go over with you guys in a brief video here, a recap of Cinemark's Q4 earnings. We listened live here on the channel to the earnings call, and we watched the price plummet all the way down to $26.50, which caught a lot of people by surprise. So I want to give you a few thoughts. We'll go over the dashboard about the relative safety of investing in Cinemark and my outlook for the company for 2025. If you're a fan of the movie industry stocks, invested in any of them, I think it's important to keep up with all of these different movie tickers. With that being said, let's get right into it. Cinemark's earnings per share for Q4 came in at 33 cents per share. If we look at what the analysts had forecast over on stockanalysis.com, highlighted in yellow in the middle of your screen, they had 38 cents for the quarter as the estimate. Over on Yahoo Finance, they had estimated 41 cents per share, a difference of about 17 to 19%. So maybe not so surprising when we put a trend line here on the move down and see that it was an 18% move down. It kind of tracks the miss that they had in the Q4 earnings in terms of percentage. Based on the executive's earnings call on the 19th and the analyst questions, what the execs said about their plans and expenses for 2025 and the expected box office, all of the analysts have now provided updated earnings estimates for the year and new price targets, and they all basically came in around an average of $35 12-month price target for Cinemark from the professional analysts. My own price target for the end of 2025 is somewhere around $40. I think these guys are being a little bit pessimistic on their box office expectations and the PE ratio that they are assigning to Cinemark. Looking at my dashboard, which is just a picture to kind of give you a feel for the safety of investing in Cinemark over the next 12 months. Always do your own DD, but these are some of the basic categories that I look at to decide whether a play is safe or not. We have mostly green boxes here, and in the bottom right, they just announced a dividend, so that box flipped from yellow to green, 32 cents a year, 1% yield on that dividend. On the middle of the top row, the company has $1 billion in cash. The debt to equity ratio is still a little bit high, so that box is yellow. In the bottom left-hand corner, the revenue growth rate flattened out, but we are expecting it to go green in 2025, especially when we get past Q1 into Q2 through Q4. Dilution risk. The company has $460 million worth of convertible bonds, which are coming due in August of 2025. And so I do have that marked as yellow for dilution risk. I want to talk with you in just a second about those convertible bonds, especially if you're listening to other people about what's going to happen with AMC's convertible bonds. You're definitely going to want to stay tuned for another few seconds. But the last thing that I want to talk about here on the dashboard is the very high short interest on Cinemark, almost 22%. And the only real theory I have on that is that it is related to hedging activities from the bondholders due to those convertible bonds. We will know more about that if you see the short interest go down after, say, July or August, when those bonds start getting closed out. Let's talk about these bonds for just a second, because if you're investing in AMC, you hear a lot of people telling you that the AMC convertible bonds are automatically going to convert at $5.66. I've made many videos explaining to you precisely why that is not going to happen, and anyone telling you that probably does not understand convertible bonds very well. These convertible bonds were issued by Cinemark in August of 2020, almost 5 years ago, and they have a conversion price of $18.66. As you guys know, Cinemark is trading at 26. It's traded as high as $36. Did anybody convert their bonds at $18.66? No. They did not. If you want to know why conversion does not happen when a stock ticker crosses the conversion price, even when it goes way higher than the conversion price like Cinemarks is, watch the video that I'm going to put a link to up here above my head, and I will go through with you how convertible bond holders think and the math they use and why conversion early does not typically happen. We would expect the conversion of these bonds to happen in July or August of 2025. Same with AMC. Very unlikely that there's going to be any conversion at 566 or any price above that until very close to the maturity date. On their balance sheet, Cinemark has cash and cash equivalents of just over $1 billion. When we listened to the CFO talk about the conversion of these bonds, she said that they're going to try and attack it with cash, but that there may be some dilution of shares also. So we don't have firm guidance of how these are going to be taken care of, but these bonds will be paid off by August of 2025, one way or another, either through cash or shares or a mix of both. Obviously, if they use shares, that would be some potential dilution to shareholders, which is why I have that box on the dashboard marked yellow. For the quarter Q4, Cinemark's revenue came in at $814 million, lower than Q3. That gave them total revenue for the year of $3.05 billion, a very slight decline from 2023 for the year. When we look at net income for the year, $304 million, and that trend from negative to well into the positive, it is easy to understand why Cinemark's price has been absolutely on fire and going up over the last year or so. With their fourth quarter numbers in, Cinemark posted a diluted EPS for the year of $2.06. And if we look at their shares outstanding, 120 million, and that net income, that gives them a trailing PE ratio of 1334, which is very reasonable, maybe even undervalued for this industry. I know a lot of people get upset when they try and compare the share price of AMC to something like Cinemark. Remember, you cannot compare companies by share price. You must factor in shares outstanding. Is the company profitable or not? And then apply a PE ratio for that industry. AMC is not profitable and you don't have a positive PE ratio. It is really not even possible at all to do an apples to apples comparison between Cinemark and AMC because of the huge difference in shares outstanding and the fact that one is profitable and one is not. At some point in the future, if AMC gets profitable, we will be able to do some sort of comparison between AMC and competitors like Cinemark, but we are still going to need to factor in the difference between the shares outstanding and the net incomes. While we are on the income statement, two other important things to look at for any company would be their profit margin and their free cash flow. For the year, Cinemark had a positive free cash flow of $315 million and a profit margin of about 10%. If you want to compare that again to an AMC and why is it struggling, AMC's trailing 12 months free cash flow is negative $560 million with a negative 9% profit margin. And hopefully that kind of drives home the difference between the two companies' financial models at the moment based on the current box office size. As the box office grows, these numbers will improve for a company like AMC, which is twice the size of a company like Cinemark and has greater fixed costs to overcome until box office grows. Moving over to Cinemark's balance sheet ending Q4, ending the year, let's look at their current ratio, current assets versus current liabilities and the working capital. Current assets, $1.298 billion. Current liabilities, $1.282. Remember, we would like to see current assets higher than current liabilities, reflecting the company's ability to address any obligations it has coming up over the next 12 months. That gives Cinemark a positive working capital of $16.6 million. If we put that in terms of financial ratios, if you were an analyst just wanting to look at this real quick, there is a healthy current ratio greater than 1.01. Current assets are higher than current liabilities. If by comparison we do that again with AMC for a trailing 12 months, or the most recent quarter anyways, total current assets $789 million, total current liabilities $1.5 billion. We have an issue here with AMC, a liquidity issue, because the total current liabilities far exceed the total current assets, giving the company a working capital of negative $789 million. So if you are wondering, does AMC have bankruptcy risk, or why is it continuing to dilute? You have a very clear liquidity problem here that the company is working to overcome. And again, as box office and revenues grow, this problem will over time resolve itself. In the meantime, the company may need to continue to raise additional cash. In terms of the financial ratio, what that means on that balance sheet, we have a 0.5 current ratio. And analysts or institutions want to see a number higher than 1 on your current ratio. A 0.5 is not a good number to have. It means your current liabilities are twice the size of your current assets and that you have a liquidity issue. Back to Cinemark, and just to finish up with their cash flow statement, just a couple of highlights to point out to you guys. They do have a positive operating cash flow for the year, $466 million. Down at the very bottom, we already talked about free cash flow in blue, $315 million positive free cash flow for the year. The company spent in yellow on capital expenditures $150 million for the year. And because they have positive free cash flow, and while earlier in the year their share price was depressed, they used some of that positive free cash flow to repurchase company stock, about $5 million worth, which investors will also see as bullish and something, if you have positive free cash flow, that a company is able to do. To wrap up, I want to cover just a couple of brief statements that Cinemark executives said on their earnings call. First, let's start off with 2025 box office. They basically reiterated what they said a quarter ago, that the 2025 box office, they expect it to be between 2019 and 2023. So somewhere in the range of $9 to $11 billion. I know that's a wide gap, but that is the only guidance they are giving us right now. They did say that they expect their cost of movie exhibition, the amount of money that they pay to the studios, to increase in 2025. So that's something that I'm going to be keeping in mind for all of the movie exhibitors, companies like AMC or Marcus Corp, to see if they give us similar guidance or not. And the final thing that Cinemark said, which I found of interest, is that they continue to plan to invest in their company and increase their CapEx for 2025. At the beginning of this video, we talked about Cinemark's price falling based on that earnings miss of 19%, both in the earnings expectations versus reality and the corresponding drop in price of, surprise, the same amount. It also fell to this bold purple line you see, which is the 200 EMA. The other thing that I'm thinking about as I consider what might be next for Cinemark is that Q1 is going to be pretty bad, far worse than Q4 was. So there may be some potential additional downward pressure in Cinemark over the next few months as those Q1 numbers get internalized by everybody or eventually reported by Cinemark. But once we get past Q1, I think that the future is very bright for this company. Analysts have a $35 price target for the next 12 months for Cinemark. I have a $40 price target. We will see where Cinemark ends up, and we will track it as always here quarter by quarter. If you guys have any questions or comments about Cinemark or the industry, please leave them for me down below. I hope you got some value out of this video. Thank you for watching all the way through. I am Tony Denaro, and I will see you on the next video.